So what's the takeaway, Alan, and the great bond massacre of 1994, as it's called? What do you tell equity investors who might be worried about the spillover effect on the economy and the markets?
Well, I think for the first obvious point is that they're not wrong in thinking that lower long rates, other things equal, are bad for equity prices. That was true then, it's true now, it's true forever. It's almost a not quite, but it's almost a tautology. The key thing, however, to watch, and market people I think understand this, is will the Fed succeed, or maybe I should say how well will the Fed succeed in achieving the elusive soft landing. The Fed, unlike some other times in history, is not trying to drive the economy into recession. It's watching and waiting, proceeding cautiously. By the way, the current yield curve slope, it's steepened a lot lately, and that's gotten all the attention. It's historically normal. Something around the 100 basis points between Fed funds and the 10-year bond rate is very, very normal historically. So if you're sitting at the Fed, you're not viewing this as a very steep yield curve. You were viewing the old one as a very flat yield curve, of course.
Alan, just to extend the 90s analogy a little bit, you've kind of taken us through and compared it to right now, where Fed officials seem to be trying to get the market's attention and focus them on the fact they're going to be raising a few more times. But Fed Chairman Jerome Powell has also invoked Alan Greenspan's treatment in the later part of the 90s, where he said, look, there's a productivity revolution going on. Maybe we won't have a lot of inflation, and perhaps that means we can go slower on rate increases as the cycle matures. Do you think there's relevance to that experience today?
I think there's tremendous relevance to that experience today. It was a period of time, going back to the late 90s, where the labor market tightened, the unemployment rate fell so low that by conventional thinking there should have been a lot of inflation, but there wasn't. And Alan Greenspan had to persuade his colleagues just to hold steady. Let's just see if we get any inflation out of this, and we didn't. We never did. It's not like it was long delayed, and by the time we got into 95, we were seeing high inflation. No, it never happened. So you go to today, you have a similar thing, although productivity, it's not being driven by a productivity miracle, which Greenspan saw early on in the late 90s. Productivity has been lagging, productivity growth, and yet there's no inflation, or very little. No is a slight exaggeration. Inflation is creeping up, but very little acceleration of inflation to be seen, despite the unemployment rate, which has now been in the neighborhood of 4% or lately lower for quite a long time.
Alan, what do you make of the picture in Europe at the moment? I mean, we see the yield on the Italian 10-year gap up 3% above the same for Germany. Do you think that will alter what the ECB can do moving forward? A lot of people, of course, expect the ECB to start to tighten policy and raise interest rates. Is this going to be a limiting factor, or at least a factor that will make the fallout from rates going up in Europe far worse than they have been in the US?
Yeah, I'm not sure about that latter, because as you say, the Italian rates have already gone up. But yes, I think this certainly has to be a factor that will be a little bit of restraining influence on the ECB. You know, you remember go back to 2012, where Mario Draghi, with words only, basically completely annihilated the yield spreads between Italian, Spanish, etc. bonds and German bonds. I mean, drove it practically to nothing. Now you have this large spread. I don't know if he's planning another verbal attack on the spread, but this looks, to an outsider, this looks more country-specific than Eurozone-wide. The Eurozone as a whole doesn't look doesn't look terrible. I think the credibility of what the Italians are saying and doing about their budget is somewhat questionable, and that's playing a role. But to your question, sure, that has to be something that the ECB takes into account as it plans its next few steps.
Finally, Alan, just on our top story, which is this rise in bond yields, when does it start impacting the economy? From a perspective of higher mortgage rates and consumer loans and small business loans, is there a level or a speed? And are we already at that point?
I don't think there's a magic number, and I don't think we're quite at the point, but it will come soon. There's probably a lag of a quarter, 2 quarters, 3 quarters before the market bond rates filter in to fully filter in. I mean, they start right away, but fully filter in to the interest rates paid by households for mortgages, for auto loans, and for businesses in bank loans and things like that. So a little bit, it's a little bit ahead in the future, but not so very far ahead.